walk me through the difference between a cash versus a stock acquisition and the differences between each method. When thinking about cash versus stock in terms of an acquisition, the core difference, I believe, comes down to certainty versus flexibility. In a cash deal, target shareholders receive a fixed payment in cash. This provides a certainty, right, of value. The recipient knows exactly what they're walking away with. From a buyer's perspective, it usually signals confidence and can be attractive to the seller who wants cash. But the trade-off is that it consumes cash on the balance sheet, or right, it can also increase debt if the company has to raise financing to support the cash deal, which can limit future flexibility and raise leverage and risk. In a stock deal, on the other hand, the buyer issues new shares to target shareholders instead of paying cash. This preserves liquidity and avoids adding debt, but it dilutes existing shareholders. It also ties the value of the deal to the buyer's stock price. If the buyer's shares are highly valued, using stock can be an efficient currency. If the stock falls after the deal, though, target shareholders bear that risk. Because of these dynamics, many real-world transactions use a mix of both cash and stock. That balance lets the buyers preserve some liquidity while still giving the seller certainty on part of the deal and part of the deal. The exact structure often depends on the buyer's capital structure, the relative valuation of their stock, and what's most attractive to the seller's shareholders.